In 2012, I walked into a Las Vegas hotel ballroom packed with people who all seemed to have the market figured out. The energy was at a fever pitch. Guys in suits were glued to their phones, women were analyzing dense charts on their laptops, and the entire room vibrated with the chaotic, information-heavy environment that most people associate with high-level trading. Between sessions, the networking was relentless. Everyone was name-dropping their complex systems, eagerly predicting the next big move, and flexing about their massive returns. It looked exactly like the cultural myth of trading success we see all over social media. But at lunch, I sat next to a quiet guy named Robert. Robert managed $20 million of his own money. He had survived the 2008 financial crash and the flash crash of 2010 without a scratch. While everyone else was hyping up their wins, Robert was eating a sandwich and reading a novel. He didn't predict the S&P. He wasn't checking his phone. When we finally talked, he only discussed his mistakes and his daily process. The public firmly equates professional trading with predicting the future, scoring massive windfalls, and being constantly in on the action. We assume the pros are the loudest ones in the room, making the biggest bets. But if surviving the hardest markets and managing 8 figures doesn't require giant accounts, anticipating the news, or having a near-perfect win rate, what exactly defines a professional? Robert wasn't at the conference to find a miracle strategy. He was there because 15 years of results had taught him that success didn't come from a new trick, but from a repetitive, disciplined routine. For him, the market wasn't a place of excitement. It was a workplace of calculated, boring order. Most amateurs approach the market themselves like gamblers. They take a position hoping to get lucky on a single isolated event, crossing their fingers that this specific trade will be the big winner. Professionals act like they own the casino. They don't care if someone wins $10,000 on a single spin. They own the mathematical expectancy over thousands of executions, knowing the long-term math favors them. They rely on a statistical edge, a specific, repeatable advantage yielding positive expected value over a large sample size. Individual trades are random, but across thousands of spins, that edge behaves exactly like a casino's built-in house advantage. This chart shows how that math plays out. A trader named Sarah relies on an option strategy where her win rate is exactly 40%. As you can see, 60% of her trades are entirely in the red, yet she is solidly profitable. Her system dictates that when she wins, those 40% of trades generate 3 times the return of what she risks on her losers. The net area remains massively positive. Give an amateur this exact same system, and the math falls apart. Driven by the emotional pain of losing 60% of the time, they start taking their profits early to feel like a winner, or they let their losers run in hopes of a rebound. That instantly destroys the crucial 1-to-3 ratio. Professionals like Sarah execute their trades without any emotional attachment to the individual setup. Their confidence is entirely anchored in the macro math. They know the next trade doesn't matter. The next 100 trades do. But having a mathematical advantage means nothing if a single bad streak takes you out. Your edge is useless if you don't survive long enough for the probabilities to play out. The primary threat in any financial market is ruin. The market is a volatile environment where unexpected negative variance is absolutely guaranteed. I once coached a trader named Mike who had a decent strategy and understood technical analysis, but he had a fatal amateur flaw. He sized his positions entirely on gut feelings. This chart shows the direct result of inconsistent risk. Mike risked 2% on one trade, 5% on the next, and 10% on a so-called sure thing. A standard string of losses wiped out months of hard-earned gains in days. The professional antidote to this destruction is absolute, the 1% rule. No matter how confident they are or how perfect the setup looks, pros never risk more than 1% of their capital on any single trade. This chart shows 2 diverging equity curves during a standard 10-trade losing streak. At a strict 1% risk per trade, the account experiences a manageable 10% total drawdown. It's frustrating, but mathematically, you're still in the game. Now look at the 10% risk approach. That exact same losing streak destroys 65% of the account capital. To climb out of that hole and just break even, the trader has to generate a near impossible 186% gain. Risk management is the ultimate priority. Professionals aren't out there obsessively managing their profits. They are ruthlessly managing their downside to ensure they stay in the game tomorrow. Compare that frantic, emotional gambling approach to the day-to-day reality of a professional like Jennifer. Her trading days aren't filled with adrenaline. They are highly structured, methodical, and almost entirely boring. She runs her portfolio like a strict business. She spends her Sundays preparing for the week ahead. She trades in rigid time blocks, meticulously logs her emotional state in a journal, and views her inevitable losing trades simply as the operational overhead of running a business. The internet constantly promises overnight wealth, telling people they can double their accounts in a month. But mathematically, chasing those massive scores inherently requires taking catastrophic account-ending risks. When you look at the actual performance targets of seasoned professionals, they aren't trying to make 100% a month. They aim for a quiet, remarkably consistent 3 to 5% return. This chart shows the hidden power of that seemingly small number. A consistent 3% monthly return compounds to over 42% annually. Given enough time, that modest baseline explodes into an exponential curve. Achieving that level of compounding demands that traders completely surrender their ego. You have to let go of the human need to be proven right about what the market will do next. Professional trading is an exercise in extreme psychological discipline. It requires executing a rigid set of rules, taking your designated stop losses, and letting the probabilities work, even when every instinct in your body screams at you to do something else. True wealth in the markets is not built by predicting a chaotic future. It is built by accepting the uncertainty, managing your downside, and operating a personal casino driven by statistical edges and relentless, boring consistency. You find the perfect setup. The stock broke resistance, volume is strong, and every indicator aligns. You execute exactly by the book, and the market immediately reverses and stops you out. This creates a specific kind of exhaustion. You're making a little, then losing a little more, watching a steady drain on your capital despite following every rule in the textbook. The human brain instinctively equates an immediate loss with a flawed decision. This is outcome bias, the tendency to judge the quality of a choice based solely on its result, rather than the logic used at the time. When you treat the market as a puzzle with a fixed answer, you are playing a game designed to break you. I remember walking a friend through a trade that had failed, despite meeting every one of my criteria. I felt like an idiot. I assumed my analysis was garbage because the stock hadn't done what I expected. He listened to my explanation and then asked, "Why did you expect it to work?" I didn't have an answer beyond the fact that the conditions were right. But a strategy that works 60% of the time carries a mandatory 40% failure rate. This trade wasn't a mistake. It was simply one of the 4 out of 10 times where the setup doesn't result in a win. Losing trades are not evidence of a lack of intelligence. They are the data points required for a probability distribution to function. Professional traders view the market the same way meteorologists view the sky. A 70% forecast of rain is a measurement of probability. A sunny day simply falls within the 30% window without rain. If a high probability trade fails, you aren't wrong. You've just clicked a yellow dot in a field of blue. Amateurs seek the emotional safety of a sure thing. Professionals accept uncertainty as the price of doing business. Consider 2 traders taken to the same long position. One uses a strict stop loss based on their system. The other ignores risk entirely, refusing to define where they will exit if the trade fails. The trade drops. The disciplined trader is stopped out for a small, planned loss. The reckless trader holds on, watches the stock eventually recover, and walks away with a massive profit. In the short term, luck rewarded the worst decision. But over hundreds of trades, the reckless approach eventually hits zero. The disciplined trader's steady upward climb is the result of a process that survives variance. The professional feels no regret about the loss because they executed their plan perfectly. To them, a good trade is defined by the quality of the execution, not the balance of the P&L. Relying on the financial outcome to judge a decision is the fastest way to lose objectivity. This creates a paradox. Attempting to control the outcome of an individual trade actually causes you to lose control of your entire account. You see this when traders widen their stop losses to avoid being wrong, or average down on a losing position to fix it. These are emotional attempts to exert power over a market that does not care about your analysis. Professionalism is the release of that control. Like a basketball player focusing entirely on the mechanics of their form, a trader focuses only on the things they can actually influence: the entry criteria, the risk per trade, and the exit rules. You gain control over your long-term results only by abandoning the need to control the next 5 minutes of price action. We have to change the definition of success. Success is following the plan. Failure is deviating from it. The money is just a consequence of that discipline over time. Even a perfect system will experience drawdowns. Clusters of losing trades are statistically inevitable and not proof that your edge has disappeared. If you flip a weighted coin 10 times, 7 tails looks like failure until the view zooms out to 1,000 flips, revealing the true edge. But traders who abandon strategies during normal drawdowns create a staircase of failure, never letting that edge manifest. Moving from a daily perspective to a macro view of hundreds of trades neutralizes emotional panic. The final trap is the ego. Many traders let their self-worth fluctuate with their account balance. When trading is your identity, a losing streak becomes a personal crisis, making it impossible to maintain the detachment required to execute a system objectively. The best traders have full lives outside the market. They treat price movement as neutral data, focusing on constant, incremental improvement rather than daily validation. Stop trying to predict the future. Control your process. Trust the sample size. Let the math do the work. A heavily watched tech company releases its quarterly earnings report. The numbers shatter all expectations. Revenue is soaring and profit margins are expanding. Across the country, retail traders flood their brokerages and hit the buy button. The logic seems undeniable. A company making more money is a more valuable company. The stock should rally. But the opening bell rings and the exact opposite happens. Instead of surging to new highs, the stock violently sells off, dropping 10% in a matter of minutes. Why does a market reliably punish good news? If a company's financial health visibly improves, why would its share price collapse? The surface-level headlines alone offer no clear explanation. Assuming that positive news guarantees positive price movement traps countless new traders, because they treat the market like a logical, predictable machine. When you first look at a trading screen, it feels like a video game. You assume good inputs lead to green candle outputs, and bad news generates red candles. You expect a direct, mechanical reaction. The reality is that a market is entirely composed of people. It is a live ecosystem of millions of individuals and algorithms, acting on their own biases, emotions, and incomplete information. Instead of a traditional auction with one item and multiple buyers, a financial market is a continuous, two-way auction. Opposing sides of buyers and sellers negotiate simultaneously every second, discovering the exact price where the maximum number of shares can trade hands. Price only moves when an imbalance occurs. If the volume of aggressive buyers outweighs the available sellers, the price is forced upward to find a new tier of sellers willing to take the other side. To make sense of sudden drops and random spikes, stop looking at static chart patterns. You must visualize the live human auction running underneath the data. Retail traders often assume every participant on the screen is trying to do exactly what they are doing: buy low, sell high, and capture a quick directional profit. That assumption ignores the actual whales in the room. Institutional investors, like pension funds and university endowments, manage billions of dollars. They cannot enter or exit a trade all at once. They must carefully build massive positions over months to avoid creating the very price spikes retail traders look for. Then there are the market makers. These firms do not care if a stock goes up or down. Their objective is to provide liquidity, capturing fractions of a penny on the spread between the bid and the ask thousands of times a minute, while continuously managing their inventory. You also have hedgers, like an airline buying oil contracts. They will gladly take a calculated loss on a financial trade if it guarantees fuel costs and protects their core corporate business. A single green or red candle on a screen is the net physical result of these conflicting agendas. You are watching distinct participants, bound by different constraints, playing entirely different games at the exact same moment. This brings us back to our opening anomaly. How does this clash of agendas cause a stock to crash on a record earnings report? The answer lies in order flow, the raw, visible stream of buy and sell orders. Order flow reveals exactly how the major players are positioned before the news even hits the wire.
Look at this timeline. Weeks prior to earnings, institutions quietly accumulated shares, pricing in the positive report. At the announcement, retail traders flood in to buy. Institutions use that sudden demand as exit liquidity, dumping their massive holdings and driving the price downward. The market does not react to the news itself. It reacts to how the heavily positioned players manage their risk and capture their profits when that news finally drops. As our stock continues its downward slide, it approaches a technical support line. Many amateur traders draw these lines on their charts, expecting them to act as a physical trampoline that will automatically bounce the price higher. But support is not a physical barrier. It is simply a historical memory. It marks a previous price point where a large cluster of buy orders happened to stop a decline in the past. The strength of that memory relies entirely on liquidity, the invisible ease with which an asset can be bought or sold. High liquidity means plenty of participants are willing to trade at that level, limiting your risk. But in the middle of a sharp sell-off, market conditions change. The buyers who defended that level have no reason to step in today. The liquidity vanishes. Without those buy orders present, the historical support level shatters completely, sending the stock into a freefall. Treating historical chart lines as guaranteed outcomes rather than probabilities is a reliable way to get wiped out. When liquidity dries up, the lines on your screen mean absolutely nothing. If we zoom out from the microscopic details of a single crash, we see that the broader market cycles between two distinct structural phases. This diagram shows a balanced market. Price oscillates smoothly within a defined range, trading around an agreed fair value. But when that agreement shatters, the market enters price discovery. Aggressive directional pressure breaks the established boundaries, dropping rapidly to find a new equilibrium. These two environments require completely opposing tactics. In a balanced market, you fade the extremes, buying the bottom and selling the top of the range. But in price discovery, you must ride the dominant trend. Applying the wrong strategy to the wrong environment is a primary cause of systemic failure. Buying a dip in a balanced market works. Buying a dip during aggressive downward price discovery is a guaranteed loss. This context expands even further when you account for time. A chaotic, violent crash on a 5-minute chart is often just a logical, temporary pullback when viewed against a dominant trend on the daily chart. Translating all these mechanics into a consistent edge requires practice. Like learning to drive, you start by consciously checking every gauge and mirror. But over time, the rigid, conscious analysis fades. You internalize the data, and your focus shifts to the clear, open road ahead. True professionals do not rely on secret geometric patterns or magic indicators. They look at a screen and simply read the human forces driving the price. Once you stop staring at a static chart and start observing the continuous human auction underneath, the market stops being a mystery. You stop reacting to headlines, and you finally stop playing checkers in a chess match. You're watching a stock tightly compressed for weeks. Suddenly, the resistance level shatters. The line spikes upward with violent momentum. Then, the surge stops. In a matter of seconds, the price collapses, blowing past your stop loss and dragging countless retail accounts down with it. The instinct is to blame the market, but the failure often traces back to how we interpret the chart. Relying strictly on geometric shapes, a triangle breaking out or a line crossing a threshold, means reacting to the surface of the data. This sudden collapse is the consequence of trading without understanding the actual mechanics driving the move. What looks like a random walk is a structured conversation. Every movement on the chart represents a negotiation between buyers pushing for higher value and sellers demanding an exit. Candle bodies and wicks provide a real-time ledger of who holds the balance of power. A slow climb reveals a lack of urgency. A sharp bounce off support exposes deep conviction. We can go back to that initial failed breakout and look at the price behavior that signaled the collapse before it happened. Aligning with this raw data shifts a trader's perspective from reacting to the price to anticipating the underlying intent of other participants. We return to the moment the price breached the resistance line. Instead of watching the peak of the rally, we have to look below it. This chart shows the relationship between the price action and the volume of shares changing hands. As the price climbs higher, the vertical volume bars below are steadily shrinking. Sustainable price movement requires the conviction of high volume. When a stock hits new highs while volume bars shrink, it reveals a lack of institutional participation. The big money has stopped buying. Now we examine the structure of the individual candlesticks right at the top of that hollow surge. This isolated candlestick shows a thin line extending above the solid body. This upper wick represents a price level that buyers reached during the session, only to be repelled by sellers before the close. When 3 consecutive candles form identical long upper wicks against a specific level, it shows that buyers are repeatedly exhausted. A wall of sellers is repelling them at the exact same threshold. A trader watching only the green bodies sees a bullish breakout, but the volume divergence and the heavy wick rejection reveal a severely weakened structure ready to cave in. That wall of sellers represents an institutional dynamic known as absorption. Retail traders see the breakout and rush to place market orders, piling in with intense buying pressure. Yet the price action flatlines. It stops advancing entirely. This order flow diagram shows the process. A massive volume of buy orders is crashing into a single resistance line, but the line doesn't budge. Institutional players are sitting at this level, passively absorbing every retail buy order to quietly build a massive short position. Large participants allow the price to edge past resistance just enough to trigger a cluster of retail buy stops. Once they have harvested that liquidity to fill their orders, the buying dries up and the trap snaps shut. Absorption is difficult to detect because it creates the illusion of intense bullish momentum while heavy distribution takes place right beneath the surface. To confirm this reversal, we have to look past the immediate price action and establish the broader context. Professionals use multiple time frame analysis to ensure their short-term entries align with long-term forces. This split-screen chart contrasts the immediate action with the larger trend. On the left, the 15-minute time frame shows a steep upward rally. But on the right, the daily chart reveals that this entire 15-minute surge is just an exhausted blip at the top of a prolonged market decline. Checking the daily or weekly chart reveals the true balance of power. A local breakout is likely to fail if the global time frame is already heavily weighted with selling pressure. A textbook triangle or flag formation holds zero value if it forces you to trade against the prevailing momentum of the broader market. When we look at that initial breakout again, the story changes. You see the price breach the line, but you also see declining volume, the upper wick rejections, and bearish daily context. Instead of buying the breakout, the professional trader shorts the rejection. When the retail buying dries up and panic sets in, they are already positioned to ride the inevitable wave of liquidation downward. Mastering this language transforms a confusing ambush into an exploitable financial opportunity. There is a danger in attempting to decode every single tick. Hyper-focusing on minute details can lead to analytical paralysis, where conflicting signals make it impossible to act. The ultimate goal is not perfect prediction. The objective is to tilt the mathematical probability in your favor by identifying the clearest signs of structural strength or weakness. Rapid assessment doesn't come from a secret indicator. It comes from thousands of hours of conscious screen time, observing how price and volume interact until the patterns become recognizable at a glance. Mastering the language of price means interpreting the constant flow of supply and demand. By moving beyond rigid geometric shapes, you finally hear the conversation the market is actually having. Financial culture often celebrates Wall Street as an arena defined by relentless speed and high stakes. Retail traders typically imagine a master's workstation as a command center, consisting of a half-dozen monitors running cascading windows of algorithmic code. This visual chaos reinforces the idea that surviving the market requires absorbing an overwhelming flood of data to stay ahead. The reality of a professional proprietary trading desk is far more clinical. The rooms are quiet, setups are limited to 2 monitors, and the charts are stripped bare. Tom, a trader who has been profitable for over a decade, relies only on raw candlesticks and volume. He views indicators as secondary derivatives that only cloud the source data he needs to make a decision. Tool addiction frequently serves as a form of procrastination. Amateurs spend thousands on Gann squares and Ichimoku clouds, hoping a complex overlay will replace the hard work of learning market mechanics. Adding tools rarely creates an advantage. More often, it introduces paralyzing noise. Trading professionally begins with the art of subtraction. A congested chart makes the actual price action nearly invisible beneath layers of oscillators and proprietary scripts. The minimalist approach requires systematically deleting every derivative indicator to find the true signal. This leaves the non-negotiable foundation of price and volume. Price records exactly where buyers and sellers agreed to transact, while volume shows the sheer weight of activity behind that decision. Professionals use these metrics to validate moves. A breakout above a ceiling carries much more weight when accompanied by volume at least 50% higher than the recent average. They also watch for a volume climax, a massive spike that signals exhaustion. These events often mark the turning points of a trend, like a blow-off top or a capitulation bottom. Mastering these raw supply and demand mechanics provides more actionable insight than dozens of expensive algorithms combined. While professionals do use certain tools, they treat them as structural filters rather than magic buy or sell signals. Moving averages, specifically the 20, 50, and 200 periods, help translate messy price action into clear, short, medium, and long-term trends. Rather than trading simple crossovers, professionals watch how price interacts with these lines. A strong bounce off a moving average confirms a healthy trend where buyers still see value. Amateurs often clutter their screens with exact horizontal lines at every minor price swing, rendering the concept of support and resistance useless. The professional method relies on zones. Market psychology operates in general areas of historical interest, rather than at a single precise penny. A few specific indicators, like RSI or MACD, can add value by measuring momentum. The primary goal here is spotting divergence. When price makes a new high, but momentum starts to fall, it signals a structural weakness that often precedes a reversal. Finally, the average true range measures volatility. It provides the math needed to size positions and place stop losses safely outside the market's daily noise. This minimalistic toolkit acts as a filter, keeping the trader aligned with market reality while protecting their capital. When the trading day ends, the professional's most vital work begins, using a tool that exists entirely outside of a charting platform. The trading journal serves as a forensic record of every decision, documenting the setup, the market environment, and the trader's emotional state during execution. Trading without this data leaves a trader blind to their own behavioral patterns. Without it, you cannot see that you consistently lose money on Fridays or sabotage your sizing after a loss. Professionals use these records to hunt for human error, recognizing that they themselves represent the biggest risk factor in their trading process. Platforms and terminals are simply vehicles for execution. Whether the data is free or costs thousands a month, the tools only facilitate analysis. They do not replace it. A true market edge emerges from the intersection of discipline, risk management, and rigorous self-awareness. In a world flooded with infinite data, mastery requires a commitment to simplicity. Success depends on the filter used to block out the noise. You are watching the perfect technical trading setup. A stock's price grinds relentlessly against a hardened ceiling of resistance, testing the level over and over as the pressure builds. Then the break happens, volume spikes, and the price punches through the ceiling. Retail traders flood the order books, confident they have caught a clean, high-momentum rally. Suddenly, the momentum dies. The price reverses direction, slicing back down through the support line and triggering a cascade of stop-loss orders. The entire move is wiped out in seconds. Standard technical analysis suggests these patterns indicate clear market sentiment, yet these textbook breakouts fail with remarkable consistency, leaving amateur traders wondering why the market seems to turn against them the moment they enter. This reversal is a mechanic known as a stop hunt. It indicates that the price is being pulled toward a specific concentration of orders, revealing a hidden layer of the market where the search for liquidity dictates every move. Liquidity is the physical machinery of a trade. It is the immediate availability of willing buyers and sellers at a specific price point. To buy a share at the current price, someone else must be standing on the other side of the screen, willing to sell it. This functions like a real estate market. In a hot neighborhood with hundreds of active buyers, a house sells quickly at the asking price. In a deserted town, a seller might have to slash their price for weeks just to find a single person willing to take the other side of the deal. For retail traders, liquidity is usually an afterthought, but for institutions, pension funds, and mutual funds, it is the primary obstacle. These players manage hundreds of millions of dollars in single positions. A large fund cannot simply place a 5 million share buy order on the open market. That level of demand would instantly exhaust all available sellers, forcing the price to skyrocket and ruining the fund's own entry price. Because they require massive pools of sellers to absorb their orders, institutional activity is focused on a single task: finding the areas where the most orders are clustered. Liquidity clusters in predictable locations. Human psychology tends to aggregate orders at clean, round numbers, creating dense pools of activity at psychological levels like $50 or $100. On a chart, these clusters form around technical levels. While a price consolidates below resistance, thousands of retail traders place their stop-loss orders in the exact same spot, just above that ceiling. The price spikes upward, piercing the resistance line. This isn't a breakout, it is a deliberate move into the dense cluster of resting orders. Triggering those retail stop-losses creates a wave of automated selling. The market is suddenly flooded with the exact supply an institution needs to fill its own position. Large capital absorbs this flood of forced selling. Once their buy orders are filled at a favorable price, the upward pressure vanishes and the market reverses. The breakout functioned as a tactical raid. The institution generated the pool of sellers it required by pushing the price into the most obvious cluster of retail stops. Reading these movements requires a shift in perspective. Price functions as a physical landscape, a map of dense matter and empty voids. Professionals use a volume profile to see this landscape. This histogram reveals the true density of the market by showing exactly where the most trading has occurred. The price slows down as it enters a high-volume node. Because thousands of orders are being filled at an agreed-upon fair value, the volume acts as physical friction, keeping the price stable. In the empty valleys, or gaps, the price moves with extreme velocity. There are no resting orders to provide resistance, so the price falls vertically until it finds the next pool of liquidity. A breakout only sustains if the market finds new liquidity to support the higher price. If it enters a void without sufficient orders to act as a floor, the move will be rejected back toward the previous high-volume zone. During a panic, this hidden architecture can vanish entirely. In a flash crash, institutional buyers withdraw their orders from the book, erasing the volume nodes. Without that friction, even a small string of sell orders causes the price to collapse until it finds the next available floor. This risk defines professional trading. The entire global market depends on this unseen layer of resting orders to maintain order and prevent total collapse. The difference between an amateur and a professional is often just a matter of what they choose to ignore. Amateurs focus on chart geometry, attempting to predict the future based on the shapes left behind by the past. Professionals track the auction itself. They look for the footprints of massive institutional capital as it migrates from one liquidity zone to the next. Reframing the core question to focus on liquidity instead of price direction provides the key to navigating the market's hidden ecosystem. It is the final step in moving from being the market's prey to becoming a participant in its true mechanics. A trader, up for the year and feeling confident, finds a flawless market setup. A stock breaks out of a multi-month consolidation with strong volume. Convinced it's a sure thing, the trader triples their standard position size. For about 2 days, the market validates the decision. The stock breaks out, doing exactly what the charts predicted. Then the price violently reverses and plows straight down toward the trader's predetermined stop-loss. Instead of taking the calculated hit, the trader makes a fatal error. They manually widen their stop loss, convincing themselves the trade simply needs more room to breathe. The price keeps falling. By the time panic finally forces an exit, the account is down $12,000. Half a year of meticulous, profitable trading is completely wiped out by a single decision. The bitter irony of this specific loss is that the initial chart analysis was correct. The setup was highly legitimate. But poor risk execution still resulted in total ruin. Amateurs look at a chart and ask, how much can I make on this trade? Professionals look at the exact same setup and ask, how much can I lose, and can my account afford that loss? In professional trading, survival is the absolute prerequisite to profit. You cannot compound returns or execute a statistical edge if you are knocked out of the game entirely. Strict risk management is the only real defense against the inevitable reality that the market will eventually turn against you. Professionals build that defense around a strict mathematical boundary, the 1% rule. They never risk more than 1 to 2% of their total trading capital on any single position. This chart shows the mathematical devastation of risking too much per trade. If a trader risks 10% of their account per trade and hits a streak of 10 consecutive losses, they lose 65% of their total capital. To simply get back to even, they would have to generate a staggering 186% return on their remaining funds. Look at the alternate curve on the exact same chart. Applying that identical 10-loss streak to an account risking only 1% per trade results in a total drawdown of just 10%. The loss is painful, but mathematically recoverable. Trading is an exercise in probability. Limiting risk per trade guarantees the trader survives long enough to accumulate the hundreds of trials necessary for a statistical edge to actually manifest. To guarantee they only risk that exact 1%, professionals reverse engineer their position sizing. The process starts by identifying a logical stop-loss location on the chart before ever calculating how many shares to buy. This diagram shows a classic stop-loss placement. The stop goes directly below a structural support valley. The trader doesn't place it there based on how much money they want to risk. They place it there because if the price breaks below that specific line, their original thesis for entering the trade is objectively wrong. Once that invalidation point is set, the math is simple. The trader takes their total 1% account risk and divides it by the exact dollar distance between their entry price and that stop-loss line. The result is the exact number of shares they are allowed to buy. A wider stop dictates fewer shares. A tighter stop allows for more. The chart dictates the position size. The trader never forces the chart to accommodate an arbitrary number of shares they decided they wanted to own. But math is useless if a trader abandons it the moment a live position goes into the red. The intense psychological pressure of losing real money often drives people to break perfectly sound systems. The most common point of failure is the retroactive adjustment of a stop loss. The moment a trader manually moves their stop further away to avoid a loss, the 1% rule is broken. Calculated risk turns instantly into unstructured gambling. This breakdown in discipline often leads to what poker players call tilt. Triggered by consecutive losses, tilt is an emotionally compromised, revenge-seeking state where a trader starts forcing bad entries just to win back what they lost. To defend against their own emotions, professionals implement maximum acceptable loss limits. These are hard, predefined financial thresholds mapped out for the day, the week, or the month. For example, a trader might set a strict 3% daily loss limit. If they hit that number by 10 a.m., their workday is over. They physically step away from the desk, turn off the monitors, and leave the room. Removing themselves entirely prevents an emotional cascade. They cannot revenge trade if they aren't looking at the market. They return the next day with fresh eyes and baseline emotions, ready to execute their strategy cleanly. Hard loss limits act as psychological circuit breakers. They intervene between the trader and the market, shielding capital from the influence of human impulse and ensuring a bad session remains contained. Precise sizing and hard loss limits demonstrate a practical truth about professional trading. Consistent profit does not require being right most of the time. This chart visualizes a strategy with a 40% win rate, paired with a 1-to-3 risk-reward ratio. Out of 100 trades, the trader loses 60 times, risking $1 each. but on the 40 trades they win, they make $3. The trader is wrong more often than they are right. Yet, because the losses are strictly capped at $1, the outsized gains of the minority winning trades mathematically overpower the losses, yielding a clear net profit. Compare that to the typical amateur outcome. They win 70% of their trades, but because they take tiny profits and let their losers run, 30 massive red bars wipe out 70 tiny green ones, resulting in a net zero or negative account balance. Recognizing this mathematical reality requires mastering the hardest discipline in trading, the willingness to hold cash and do absolutely nothing when market conditions do not align with your proven edge. Amateurs feel compelled to be constantly active. Professionals step aside. Preserving capital during choppy, unpredictable market periods guarantees they have the financial ammunition necessary when a high-probability setup finally emerges. To maintain this level of patience, professionals require tangible accountability. One trader keeps a framed screenshot of his worst day on his desk, the day he lost 18% of his portfolio. Whenever he is tempted to force a marginal trade, he looks at that physical record. Your statistical edge might be small, but a proven, disciplined risk management system ensures that edge actually matters. It is the essential armor allowing a trader to survive market chaos long enough to watch probabilities play out in their favor.
You spend your first few years of trading staring at charts until 2 in the morning. You buy the courses, you read the books, and you endlessly swap out indicators trying to find the one combination that finally makes the market move in a way you can predict. You're searching for a secret system, a specific set of rules that produces positive returns month after month, while eliminating the anxiety of being wrong. Then you talk to traders who have pulled money out of the market for a decade, and you ask them for the secret. Their answer is usually frustratingly simple. They trade failed breakouts, or they buy pullbacks to a moving average. The mechanics are basic. The difficulty lies entirely in having the discipline to execute the same simple setup hundreds of times without wavering. Amateur traders struggle because they demand absolute certainty from the market. Professionals succeed because they accept that certainty is impossible and focus entirely on probability. This animation of a roulette wheel shows how that probability actually works. In trading, edge is simply a systematic advantage over other participants. The casino has an edge because the green spaces give them a slightly higher mathematical probability. The manager accepts they have no way of knowing if the next spin will be red or black. Individual losses are irrelevant to the casino's business model. They happily pay out lucky players because the math guarantees that over thousands of repetitions, their small advantage will produce a profit. Trading edge is a mathematical probability that only translates into profit through relentless repetition. Advantages exist in many different forms. Some traders exploit specific time frames that others ignore. Some recognize specific technical candlestick chart patterns, while others process clinical trial data or economic reports faster than the rest of the market. The method you choose must align with your psychological makeup and your real-world schedule. You cannot sustain a strategy that creates friction with your daily life. An impatient person will likely fail at long-term swing trading because they cannot handle weeks of inactivity. Conversely, a person with a demanding full-time job will struggle to day trade high-speed price action at the market open. A profitable edge is a direct reflection of how your own mind processes market data and handles risk. Finding that reflection starts with a vague intuition about a market pattern. To turn that intuition into an edge, you have to define it with precise, testable criteria, specific rules for entry and exit that leave no room for guesswork. This animation demonstrates backtesting. You scrub historical charts, applying criteria to past setups, filtering them into wins and losses to reveal win rate and expected drawdown. Next, paper trading verifies you can spot these setups live without a completed chart. The final step is risking real capital, but at a fraction of your normal position size. This introduces the psychological pressure of a real loss, while protecting you from a catastrophic mistake. Real edge is painstakingly forged through the repetitive work of data collection and rigorous verification. Without this data, it is dangerous to assume a winning streak means you've found a strategy that works. In small samples, random luck looks identical to a genuine edge. This scatterplot shows how unreliable data is in the short term. The first 20 trades are wildly erratic.
The trend only becomes predictable once the sample size reaches 100. You need at least 100 executions before the data can be trusted. Reaching that 100 trademark requires surviving inevitable, painful drawdowns. You will hit a streak of losses that makes you want to abandon your plan, and sticking to your rules in those moments is the hardest part of trading. An edge only provides value if you have the stoicism to execute it flawlessly through periods of inevitable loss. If you put in the time and develop a proving edge, you will discover that professional trading is incredibly boring. You are simply running the same routine and looking for the same patterns day after day. A small, boring edge compounds over time. A consistent 3% monthly return turns 100,000 into $500,000 in 5 years. Conversely, amateurs try to double their accounts overnight. Their results remain volatile until they inevitably lose everything. Building wealth in the markets requires the relentless execution of small, unglamorous advantages. Even a proven advantage will eventually stop working. Markets evolve as others discover the same patterns, and strategies that produced profits for years will deteriorate. Professionals monitor their performance data to identify this decay early. They know when to stop trading a dying edge and begin the process of building a new one for the current environment. Stop looking for a perfect system. Identify a unique advantage, test it ruthlessly, and let compounding do the heavy lifting over the next decade.
Many traders eventually figure out what to look for in the market. They identify a pattern that works, but their results remain entirely unpredictable. One week they make money, the next they give it all back in a series of erratic losses. They operate under the illusion that they have a plan. They tell themselves they buy pullbacks or look for bounces off moving averages, mistaking a general description of a goal for an actual executable strategy. A vague set of guidelines leaves every decision open to interpretation. A true system dictates unbreakable rules for every conceivable scenario, stripping away the guesswork. It forces the trader to answer exactly what they trade, how they calculate their position size, precisely where their stop loss goes, and when they will exit, all before a single dollar is put at risk. Making up rules on the fly creates paralyzing anxiety in the heat of the moment. Operating with predetermined, tested rules provides a completely different experience. The trader no longer has to trust their gut. They simply follow the process. Raw market intuition cannot survive the daily pressures of trading. Long-term survival requires removing human emotion entirely and building a mechanical, repeatable machine. The life of a trade begins by defining the exact boundaries of where to operate. This means establishing strict parameters for market selection, restricting focus to specific price ranges and volume minimums where an edge has been proven to exist. From there, the system applies an environment filter. If the broader macroeconomic trends do not favor the strategy, the rules mandate sitting entirely in cash. Once the environment is favorable, the focus narrows to the individual asset through hyper-specific setup criteria. The stock must meet an exact series of technical conditions that leave no room for subjective interpretation, but a setup only tells the trader to pay attention. The actual commitment of capital requires an entry trigger, a separate, distinct rule dictating the exact moment to strike. This is where passive chart watching gives way to intense psychological pressure. The physical act of risking money forces the mind to second-guess everything. This chart shows price comfortably above a trend line, the setup. A precise entry trigger ignores momentum, waiting for specific closing conditions. The system demands patience until a singular condition forms, like an elongated wick bouncing off support. Once closed, it demands immediate execution, no hesitation. A systematized trigger entirely eliminates the paralysis of decision-making. By making the entry mechanical, the burden of being right shifts away from the trader's emotions and directly onto the historical data. The moment the order is filled, the rules shift from seeking opportunities to protecting capital. Risk control immediately overrides profit ambition. The placement of the stop loss must be an unbreakable rule. It is positioned based entirely on market structure or volatility, completely divorced from how much money the trader feels comfortable losing. This visual equation demonstrates how position sizing is calculated. The technical distance to the stop loss dictates the exact number of shares purchased. ensuring the total dollars at risk remains perfectly constant on every trade. While the trade is active, rigid management rules dictate when to move trailing stops or scale out of positions. This prevents the emotional urge to lock in profits prematurely just to feel the relief of a win. Closing the trade is driven by mechanical exit criteria. Whether hitting predefined profit targets or strict time limits, the system closes the position while entirely ignoring the trader's hope for a miraculous reversal. Even after the exit, the process continues. A mandatory post-trade procedure requires logging specific R multiples, rating the quality of execution, and tracking emotional states into a permanent database. These strict mathematical guardrails and rigorous data collection protocols do something vital. They transform trading from a speculative gamble into a predictable corporate accounting exercise. The greatest threat to this machinery is the person operating it. There is an immense, constant temptation to abandon the rules when live money is fluctuating on the screen. A single improvised decision, even if it happens to result in a profitable trade, instantly destroys the statistical validity of the entire system. To combat this, professionals deploy a final guardrail, the 100-trade commitment. This mandate forbids any modifications to the system until a massive sample size is reached, prioritizing strict compliance over the outcome of any individual trade. Losing streaks are a normal part of probability. Tweaking the rules after a brief string of losses is simply an emotional reaction to standard statistical variance, not evidence of a flaw in the system. A trading system operates exactly like a corporate business plan. A successful restaurant doesn't rewrite its entire menu just because it had one slow Tuesday. The sheer repetition of following the rules, trade after trade, is what eventually allows the mathematical advantage to outpace the inherent randomness of the market. A conceptual edge is meaningless to enforce it. Rigorous, unyielding adherence to that system is the single dividing line between a gambler making bets and a professional executing a business. Picture two identical sailboats navigating a turbulent sea. They share the same design, wind conditions, and exact same crew size. But suddenly, one vessel surges aggressively forward, leaving the other far behind. In trading, this exact scenario happens constantly. A hedge fund manager tracked two traders working under him who traded the exact same system. They had identical win rates and identical reward-to-risk ratios. Yet at the end of the year, one trader was up 12%, while the other was up 38%. It is natural to assume the winning trader somehow picked better moments to enter the market, but the data showed otherwise. The 26% difference in their annual returns came down to a single, often overlooked variable, the exact size of the positions they took. Professional traders use position sizing as an active mathematical tool to maximize their edge, scaling capital into specific trades to amplify their return. The most common approach to risk is either relying on a strict, static 1% rule for every single trade, or choosing a size based entirely on a gut feeling about the market. To understand why arbitrary sizing is dangerous, we have to look at a concept called the risk of ruin. This chart tracks two identical trading strategies over hundreds of trades. The only difference is capital risked. The first curve steadily climbs. The second experiences massive, violent swings, crashing down past a 50% loss threshold. The math reveals a harsh reality. With a 55% win rate, risking 1% per trade ensures long-term survival. But increase that risk to 10% on the exact same strategy, and the math creates a nearly 50% chance of losing half your entire account. Large static positions break trading accounts. To survive and actually grow capital, you have to build a dynamic architecture of risk. Building that architecture starts with the setup. Since no two trading opportunities are exactly alike, professionals grade them before assigning capital. This diagram illustrates how a professional risk model is constructed. We start with a baseline risk of 1%. From there, we adjust. An A-grade setup might keep that 1% allocation, but if the setup meets every primary criterion perfectly, earning an A+ grade, the risk scales up to 1.5%. A marginal B-grade setup drops the risk down to 0.75%. From that baseline tier, traders layer on the conviction variable. They add or subtract fractions of a percent based on objective signals, like unusual volume confirming a thesis, or multiple timeframes aligning perfectly.
Once the target size is calculated, it rarely goes into the market all at once. Instead, traders use scaling. They commit an initial 40% of the position and only add the remaining tranches as the trade moves in their favor, reducing upfront exposure. Quantifying subjective confidence into strict percentage tiers prevents emotional, in-the-moment gambling. The trade setup only accounts for the internal quality of the idea. The next layer requires looking outward, adapting the risk to external market conditions. Professionals measure market chaos using average true range, or ATR. During periods of high volatility, price swings widen. To keep the actual dollar amount of risk constant when stop losses have to be placed further away, the position size has to shrink. The trader's own financial evolution dictates the next constraint. A $50,000 account allows for aggressive mathematical scaling to chase growth. A $2 million account requires a completely different approach. At that size, risking even a fraction of a percent on a small cap stock can force the trader to buy tens of thousands of shares.
If that position represents 20% of the stock's daily volume, the trader becomes trapped by their own liquidity, unable to exit the market without crashing the price. A professional risk architecture breathes. It scales up and down in direct response to the market's volatility and the size of the trader's bankroll. Even with perfect sizing rules, there is a mechanical trap that ruins accounts. It starts with a simple assumption. If you risk 1% of your account across 3 separate trades, your maximum possible loss is capped at 3%. That assumes those positions are completely uncorrelated. If a trader holds 3 tech stocks and the entire sector suffers a sudden shock, all 3 assets will crash simultaneously. The panic bypasses individual stop losses, leading to severe slippage and massive drawdowns. Professional systems use hard limits on correlation, capping exposure to a single sector or systematically decreasing size across all parallel trades to account for shared risk. A stop distance heat map bridges the gap between a risk percentage and a physical share count, keeping the total dollar risk locked in at exactly $1,000. The math is highly sensitive to the exact entry point. If a setup allows for a tight 50-cent stop loss, you can buy 2,000 shares. If a different setup requires a $10 stop loss, you can only buy 100 shares. Both trades risk the exact same $1,000. Buying the same flat number of shares for every trade means risking wildly different amounts of capital. The precise share count must be calculated against the distance to the stop loss before any order is placed. True risk control is establishing the exact mathematical link between your account capacity, your stop distance, and your sector exposure, all before you ever click buy. There is a mathematical formula known as optimal F, designed by Ralph Vince, that calculates the exact position size needed to achieve maximum possible account growth over time. On paper, the mathematical theory is absolutely flawless, but when applied in practice by real human beings, the model collapses. Optimal F often demands risking upwards of 20% of your capital on a single trade. While mathematically sound over an infinite time horizon, those enormous position sizes create brutal drawdowns. It breaks human psychology, leading directly to panic and abandoned systems. Professionals operate in a middle ground. They look for a position size that is large enough that a loss forces them to pay attention, but small enough that it doesn't trigger emotional devastation. A theoretically imperfect formula that a human being can actually execute consistently is vastly superior to perfect math that causes emotional ruin. A professional trader operates on the exact same mechanics as a casino. They both rely on a slight statistical edge, applied consistently over thousands of independent events. Casinos secure their profit by strictly capping bet sizes, making it impossible for a single event to move the needle against their total capital. If a casino allowed a patron to bet 10% of the house's entire bankroll on a single hand of blackjack, eventually a lucky player would wipe them out. By keeping individual bets small relative to their total capital, they ensure time is always working in their favor. By systematically calculating share counts, adjusting for volatility, and isolating correlation, a trader adopts the house edge. They operate with the mathematical certainty of the casino. Imagine a trader who spots a flawless setup. A stock is consolidating at a clear support level in the middle of a strong uptrend. Based on the data, the trader correctly predicts a breakout and a sustained rally.
But as the trade unfolds, the entire structure collapses for them. The stock behaves exactly as predicted. It breaks out, rallies 15% over 2 weeks, pulls back slightly, and then climbs even higher. Yet the trader walks away with a net loss. They bought too early, before the actual breakout, and were stopped out during the final consolidation. Frustrated, they chased the move after it had already rallied 8%, only to get stopped out again on a brief pullback. They watched the final leg up from the sidelines. Being right about market direction means nothing if you cannot execute properly. A prediction is merely a hypothesis. The entry and the exit are reality. The moment an order fills and capital is at risk, the psychology of the market takes over. The brain abandons logic. Fear of missing out drives traders into rapidly advancing prices, while greed convinces them to ignore their planned exits. To survive in these conditions, a trader has to separate their forecast from their mechanics. The analysis determines what you think the market will do, but strict, calculated rules for entries and exits determine whether you actually keep the capital. Every entry is a mathematical trade-off. It is impossible to secure the lowest price and the highest certainty at the same time. You have to choose which advantage you want and what you are willing to sacrifice to get it. This matrix plots that exact trade-off. Professional traders approach this in 3 distinct ways. The first is the early entry. A trader buys at the very first sign of a reversal, often going against the crowd. You get the best possible price and a very tight stop loss. But because the setup hasn't proven itself yet, the risk of immediate failure is high. The win rate hovers around 40%. The second approach is the confirmation entry. Here, the trader waits for a proven bullish reversal pattern before committing capital. They are intentionally buying higher, meaning the entry price is worse and the potential reward is smaller. But because buyers have already stepped in, the win rate jumps to 60% or higher. The third option is a tiered entry, a deliberate compromise. A trader enters 50% of their position early to capture the good price, and adds the final 50% only after the trend confirms itself. They gain early exposure, but only risk full size on trades that immediately work. Once the timing is chosen, the mechanical execution must match the strategy. In fast-moving, highly liquid markets, traders use market orders to guarantee immediate execution, accepting fractions of a cent in slippage. In less liquid stocks, or when buying at a specific support level, limit orders are used to cap the maximum price paid, though the trader risks missing the fill entirely. Where amateurs fail in this phase is by acting out of sequence. When price moves rapidly, fear of missing the trade takes over. They chase advancing prices, buying right as the initial momentum exhausts, virtually guaranteeing a poor risk-to-reward ratio. There is no universally perfect entry. There are only mathematical compromises. The correct choice depends entirely on a trader's specific edge and their tolerance for being wrong. The moment an entry is executed, the posture shifts entirely to defense. Professional survival requires defining the exact price where the initial hypothesis is proven wrong. Look at this candlestick structure. Amateurs often place their stops point blank on the support line. Professionals place their exit mathematically, a few cents below the structural support. This ensures they avoid getting knocked out by brief, volatile wicks that simply test the level before the trend resumes. Others use the average true range, or ATR, to place their stops. If the daily price action becomes highly erratic, the stop automatically expands downward to give the trade room to breathe, adapting the defense to the current market volatility. These are hard stops, automated orders placed directly with the broker. Attempting to use a mental stop, where a trader plans to manually exit when a price is hit, is a known trap. When the price crosses that threshold, the human brain finds reasons to give the trade just a little more room, resulting in a severe loss. Even with a hard stop, execution isn't always flawless. During extreme market events, overnight gaps, or low liquidity, a stop might execute at a worse price than intended. This slippage is unavoidable. Professionals calculate it into their risk models before they ever place the trade. A hard stop loss is designed to protect capital, but its true utility is psychological. It completely eliminates hope from the equation, preventing a trader from trying to bargain with a losing position. There is a common saying on trading floors:
Entries get you into the market, but exits are where the money is actually made. A flawless entry will still drain your account if you have no method for extracting the profit. The most straightforward method is the fixed target. A trader decides in advance to exit their position when the profit reaches exactly twice their initial risk. When the price hits that line, the trade is closed. It removes all mid-trade emotion and secures the capital, even if the stock rallies further. To capture much larger moves, traders use a trailing stop. As the price trends upward, the exit floor moves up with it. The stop is locked in directly beneath each new higher low. It acts as a ratchet, securing accumulated profits while letting the winner run until the trend finally breaks. A hybrid approach combines both mechanics. The trader scales out, taking 50% of their profit at a predetermined node, while leaving the remaining half on a trailing stop. It balances the certainty of immediate cash with the mathematical upside of a massive trend. The greatest risk during this phase is adjusting the parameters while the trade is active. A stock approaches a target, greed takes over, and the trader cancels their exit order, hoping for more. The price reverses, and a planned winner turns into a realized loss. To prevent capital from sitting idle in stagnant, choppy markets, professionals also enforce time exits. If a setup hasn't hit its target within 10 trading days, the trade is closed at the market price. Taking a position exposes capital to risk. Extracting that capital back out of the market requires rigid, uncompromising adherence to a predefined set of exit rules. Consistency requires a shift in mindset. You stop trying to hunt for the perfect setup and start focusing entirely on the perfect execution of your system. That system lives inside the playbook. It contains exact specifications for entry triggers, precise stop placements, and rigid scaling rules. Every decision is mapped out logically long before the opening bell rings. Trading success depends on outsmarting your future emotional self before the market opens. Real-time decisions are vulnerable to instinct. Rules must be finalized in advance. In the heat of the moment, a trader will find endless reasons to deviate from their plan. But over a sample size of hundreds of trades, a trusted mechanical system will mathematically defeat human intuition every single time. Build the playbook. Trust the established rules. Accept the outcomes, win or lose, and completely remove the human from the execution. You watch the price slice through your stop loss, and in a matter of seconds, an $8,000 balance disappears. The financial hit is immediate, but the real damage is the visceral, gut-wrenching realization that you just watched your account drain. You find yourself staring at the chart, convinced the market is wrong and the price will bounce back any second. When it doesn't, you start pleading with the screen, vowing to exit the moment you hit break even. But as the position finally closes out, that desperation turns into a heavy, quiet doubt about whether you're actually cut out for this. That doubt often triggers a dangerous reflex, revenge trading. You feel a burning, urgent need to win that money back right now, which forces you to ignore your strategy and hunt for any marginal excuse to get back into the market. This cycle, trying to avoid any loss at all costs, then desperately chasing its recovery, is the emotional mechanism that destroys amateur accounts. Veteran traders operate in a different statistical reality. Over a career of 10,000 trades, a seasoned professional will likely experience 6,000 absolute losses. Despite failing thousands of times, these traders maintain high levels of profitability over the long term. Their advantage isn't a higher win rate or a secret ability to predict the future. They simply have a strict mechanical process for losing. Profitable trading relies on an operational framework designed to survive and thrive through inevitable, repeated failure. Every physical business has overhead costs. A restaurant owner pays rent, buys fresh ingredients, and keeps the lights on regardless of customer foot traffic. A successful owner doesn't view the monthly electric bill as a personal failure or a sign that the business is broken. In the markets, stop losses are that electric bill. Losing trades are the mandatory financial expenses you must pay to access winning setups. Once you remove the personal sting from a loss, it stops being an emotional crisis and becomes a routine, manageable data point. This grid shows a system with a 60% win rate, 60 wins, 40 losses. Outcomes don't alternate predictably, they cluster. It's statistically normal to see sequences of failures.
There's a 1% probability of 5 consecutive losers. It's a mathematical certainty that happens eventually. When a trader hits an expected losing streak and panics, they often abandon their strategy. They stop the process right before the statistical edge has a chance to play out. Variance is a feature of the markets, not a bug. Understanding this prevents a temporary run of bad luck from feeling like a personal attack. Immediately after a loss, a professional takes a mandatory break. Stepping away for 5 minutes allows the biological spike of frustration to dissipate. When they return to the desk, they begin an objective audit. They check the logs to see if the trade followed their predefined rules or if they compromised their discipline. Next, they categorize the loss. A good loss is one where the execution was flawless and the risk was managed, but the market simply didn't move in their favor. A bad loss is different. It only occurs when a trader actively violates their own risk parameters, like widening a stop or sizing up to make it back. Categorizing these outcomes shifts the focus away from the uncontrollable behavior of the market and onto the trader's own controllable execution. Even with a clear process, your brain is wired for mental accounting. A $500 loss feels devastating when you're down for the month, but irrelevant when you're already in profit. Professionals neutralize this bias by ignoring dollar amounts and measuring trades in R multiples. Every trade is simply a standardized unit of risk, or 1R. By thinking in units rather than currency, a trader can process a loss with the same logic whether their account is at a record high or in a temporary drawdown. Decoupling your decisions from daily fluctuations prevents your temporary financial context from corrupting your long-term analysis. Because these losses are treated as standardized business expenses rather than personal failures, veteran traders can review their worst failures in open groups. Sharing the data removes the isolation that usually keeps struggling traders silent. Even the most successful traders in the world lose money constantly. They have learned to view the sting of a loss as a shared operational hazard, not a secret to be hidden. Mastery in the markets isn't about winning every trade. It is about a fundamental shift in how you define a good day at the desk. Real success is measured by the flawless execution of your system. When you focus only on what you can control, loss resilience becomes a trained, mechanical advantage.